let's go across to our first corporate on the show. We have Samhi Hotels. They reported a steady set of numbers in the past quarter. The EBITDA margin was impacted due to the change in the GST slab. We have with us Mr. Ashish Jakhanwala, the Chairman, MD and CEO at Samhi Hotels. Well, Ashish, good morning and good to see you in as always. Well, that's one of the sectors that, continues to do well. So you've got the sectorial tailwind as well. Let's focus on a couple of data points though. Earlier, we were talking about mid-teens revenue growth. As of the 9 months, you're done close to 12.5%. Do you think you can keep up the pace? And also, what kind of occupancy and average revenue per room you're looking at in Q4? Please go ahead.
Hi, morning. Good to have me again. So you're absolutely right. I think this last 9 months have delivered the early teens in terms of total revenue growth. We don't see any reason why it should moderate in the next 12 months to 18 months. Let's not forget, Nigel, that the last 9 months had a bunch of negative events for the sector, starting with the India-Pakistan issues in the first quarter. We have the Ahmedabad crash, unfortunate crash, same quarter. Then we had very bad monsoons leading to some cancellations. And then we had the Indigo incidents in December. So I think what it shows is that the sector has so much demand that it remains resilient to these event risks. So no reason it should not maintain that early teens growth for the next year.
Okay. Early teens. Okay. Sorry.
And you want to tell us about Q4 with regard to occupancy and average revenue per room?
So occupancies, if you see, remain flattish in the upper upscale and upscale segment, but the rates grew upwards of 7 percentage points. So all of the revenue growth actually came from rate growth. In the mid-scale segment, we actually saw, interestingly, an uptake in the occupancies also. Like to believe that was some bit of an outcome because of the GST rationalization. The prices have dropped, so it's boosting some bit of demand there. So we expect the occupancies to remain stable in the, I would think, 73 to 75% in the current quarter. And the rate growth is what will continue to drive a double-digit total revenue growth.
Now, what will margins look like? Because on account of GST 2.0, we did see an impact on your mid-scale properties by 500 basis points and overall on margins by 200 basis points. So Ashish, going ahead, what is the expectation on margins?
So I think this quarter we reported about 37% margins, would have been about 39% if GST changes were not implemented. But I think the revenue growth is very strong. We should go back to 39% margin over the next 2 quarters. So that's where we expect margins to really stabilize.
Got that. And this, your long-term guidance for the RevPAR, the revenue per occupied room, is 9 to 11%. But you've been consistently clocking in a number above that, 13.3% in Q3. Would you like to change that guidance, at least for the near term, since you're confident about growth sustaining for the next 12, 18 months?
Not really. I think, see, long-term is long-term. It's not 2 quarters. So when we give a long-term guidance, we're talking about 3 years, 4 years. So there will always be great quarters. There'll always be quarters which will slightly disappoint. But I think we have models that we built over the last 14 years, and that show that the same store, and I want to be really clear, we're talking about same store of hotels, which means no renovation, no rebranding, no new inventory. So total revenue growth obviously will remain far ahead of that. But same store hotels, I think we should underwrite, if you're optimistic about 11, 12%, if you want to be realistic, then closer to 9 to 10% CAGR for next 3 to 5 years.
Okay. All right. Ashish, a couple of more numbers. Management fees as a percentage of your sales, I think it's around 5%. Where do you see this number headed? And also the non-hotel business, how much can it contribute to the entire pie, say real estate and the other, verticals that you have?
So the management fee will remain to be around 5%. That's been the long-term percentage contribution that we pay to the operators for running our hotels. And actually, we don't have any ancillary business. All of our income comes from hotels. What you see as other income is largely ancillary facilities that we provide in hotels, such as cab rentals and so on and so forth. We don't have any real estate exposure. We used to have very small office space in Sheraton, Hyderabad, which we shut last year, and that's been converted to additional rooms.
Okay, all right. Final question. What about the net debt number, holding at around 1,450 crores? What does it come down to?
Yeah, so I think, Nigel, we are very good in terms of our balance sheet now because we, as the presentation mentions, we produced about almost 300 crores of free cash in the trailing 12 months. And that's more than adequate to fund all of our growth initiatives, which are pretty robust, actually. You're almost seeing about 1,900 rooms being either renovated or added in our portfolio, and most of it being funded from free cash. So the net debt number will remain rather stable, and the net debt to EBITDA will remain also stable around 3 zip code in the short term.
Okay. Ashish, the two big projects for you are the Navi Mumbai one and the other one is Hyderabad. Can you give us the inventory expansion outlook for every year from here on? How many rooms get added? When do these two large ones complete their phase one, etc.?
So W Hyderabad, quite confident, should at least open in the next fiscal year, but the contribution obviously will then come in FY28 because our target is to open W Hyderabad around end of calendar year 2026. But the first 6-8 months in hotels are always a little weak. Then the second actually would be the Westin in Bangalore, even before Navi Mumbai, because we had acquired a hotel in Bangalore which was 142 rooms. We're going to renovate that hotel and rebrand it as Tribute from Marriott and also add a 230-room Westin block. That should really get done in FY29. So FY28, you'll see the impact of W Hyderabad, FY29, the Westin in Bangalore, plus the rebranding. And then next year is a big Navi Mumbai project, which is almost 700 rooms. So I think starting FY28, 29, 30, we have very robust pipeline coming our way. And for FY27, we will see impact of some of the hotels we had bought last year, like the Trinity in Bangalore, and some of the inventory which we've opened this year to start impacting our numbers.
All right, Ashish, great conversation. We wish you all the best of luck, and maybe time to introduce the gold scheme, Ashish. I mean, I mean it half jokingly with what's happening with gold, right? And we were all wondering where the next wealth effect is going to come from. The first one was from stock markets, and hopefully we have this impulse from gold. But just joking.
The next wealth will come from people who continue to work hard and not just be traders. So I'm quite sure about that.
No, gold. No one is trading. Gold is, of course, has been there in households for a long, long time. Thank you very much, Ashish. Appreciate it.
Thank you, Prashant. Bye.
Okay.